So imagine you finally hand in your notice, right? You walk out of that glass corporate building and you actually take control of your destiny.
Oh, the dream.
Yeah, exactly, the dream. And you're probably picturing, I don't know, a sleek tech startup or maybe like a boutique fitness studio.
Right, something flashy.
Exactly. But what if the ultimate path to financial freedom is actually, well, a giant weatherproof steel box sitting in someone's driveway?
I love that image.
Right. I mean, the moving and storage industry is famously boring. But as we get into our deep dive today on the franchise model of a disruptor like STORsquare, um, boring starts to look incredibly beautiful.
It really does.
Yeah.
Because, when you strip away the emotional fluff and the glamour of those highly publicized consumer trends,
The shiny object syndrome.
exactly, the shiny objects,
Yeah.
when you strip that away, you are left with the actual mechanics of how wealth is generated
Mm.
and preserved, honestly.
Which is exactly what we want to talk about.
Right. We are looking at an industry that is universally needed and, frankly, heavily recession resilient.
Mm.
I mean, people move when the economy is booming and they downsize into storage when the economy is shrinking.
Yeah, it's like you win either way. And that's exactly why we're unpacking this specific model today. We want to look at STORsquare strictly through the lens of buyer psychology, unit economics, and, multi-unit growth strategies.
Right.
Because if you are making this leap, especially if you're leaving a really comfortable corporate salary, your immediate fear is probably, well, competing against the 800-pound gorillas in the room.
Oh, absolutely. The legacy brands.
Yeah, those massive national discount providers that literally everyone already knows. So how do you even avoid a race to the bottom on price against, brands with billion-dollar marketing budgets?
Well, you avoid it by just not playing their game at all.
What do you mean?
So the national discount providers, they operate on this volume-based, incredibly low-touch model. If you've ever used one, you definitely know the friction points.
Oh, I have. It's a nightmare.
Right. You get routed to some massive centralized call center where the representative has like zero local geographical knowledge of your city.
Right. They don't know that your street is too narrow for a massive truck.
Exactly. And then you're given this agonizingly vague delivery window. And, the quote you get on the phone rarely matches the final invoice because of hidden transportation fees or fuel surcharges.
So frustrating.
Right. So STORsquare's entire positioning is hyper-local and premium.
Okay, so as a franchisee, you're basically competing on transparency.
Transparency and accountability. I mean, you offer a dedicated local rental coordinator, not a call center. You guarantee upfront pricing with zero hidden fees.
That's a big deal.
It is. But most importantly, you actually guarantee delivery dates.
Okay, yeah.
In the moving industry, timing is literally everything. I mean, if the closing on a house is Friday, the container absolutely has to be there Friday.
Right, or the whole chain falls apart.
Exactly. So STORsquare guarantees the date, and if they miss it, the delivery fee is completely waived.
Oh, wow. That's putting your money where your mouth is. That's a really strong hook for the consumer. But let me push back on the core product for a second.
Sure.
Because at the end of the day, isn't a box just a box?
Oh, I hear this all the time.
Right. Like, if I am looking at this as an investor, I get the value of great customer service. But if people are just shopping for a metal container to, hold their old couch, aren't they just going to pick the cheapest option?
See, that assumption is exactly why the legacy brands have gotten away with inferior products for so long.
Mm-hmm.
And it actually starts with a misconception you just voiced.
What the?
You said they were all metal. They aren't.
Wait, really?
No. A significant portion of the national discount fleets are actually built using really flimsy materials.
You're kidding. I genuinely assumed they were all steel?
Not at all. We are talking about like wood panels with plastic covers or these composite materials that warp over time.
Wood and plastic. That sounds like a massive liability if you are storing someone's, I don't know, antique furniture for 6 months.
It is a massive liability. I mean, they leak when it rains. They sag under heavy snow. It's bad.
Yikes.
Yeah. But STORsquare units, by contrast, are solid, all-steel units. Heavy-duty steel walls, reinforced framing, and this is key, a seamless single-piece roof to prevent water ingress.
Oh, so no seams for water to sneak into.
Exactly. Plus, they use these wide-opening barn-style doors, and they sit flat on the ground.
Meaning ground level entry.
Right. So the customer isn't dragging a heavy refrigerator up a precarious bouncy ramp.
Okay, yeah, the physical asset is demonstrably better. I get that now. But you mentioned earlier that the delivery mechanism is where the real disruption happens.
Oh, it is. It's called the no-tilt mule delivery system.
The no-tilt mule. Okay, explain that.
So traditional containers are delivered using a standard winch on a flatbed tow truck.
Right.
The winch hooks the container and literally drags it up onto the bed at a very, very steep angle. And, well, gravity does what gravity does.
Oh, no. So the customers carefully packed boxes, their dishes, their television.
Yep. It all shifts and slams against the back doors.
Right. And then when it's dropped off at the new house, it just slides all the way back the other way.
Exactly. It's a mess. But the no-tilt mule is this specialized robotic delivery system that lifts the container perfectly level.
Perfectly horizontal.
Completely horizontal. From the moment it leaves the ground, onto the truck, and back onto the new driveway.
That's incredible.
It is. And furthermore, the mule is highly maneuverable. It can navigate really tight, narrow spaces, squeeze under low-hanging branches, and even place containers on steep driveways that a massive traditional winch truck simply cannot physically access.
Wait, okay. A specialized, highly maneuverable robotic mule. That sounds incredibly expensive to buy and maintain compared to just, leasing a standard commercial tow truck.
A fair point.
Doesn't that heavy capital expenditure severely eat into the franchisee's margins?
It's a fantastic question, and it's where you really have to look at the long-term unit economics rather than just the initial sticker shock.
Okay, walk me through it.
Yes, the specialized equipment obviously requires investment, but let's look at the return on that equipment. First of all, your damage claims plummet.
Because things aren't sliding around.
Exactly. You aren't paying out insurance claims for broken dining room tables. But second, and this is the big one, you unlock premium zip codes.
What do you mean?
Think about high-density, wealthy neighborhoods, narrow streets, tight urban driveways, historic districts with lots of trees.
Oh, sure.
The competitors literally cannot service those homes with their massive trucks. You can.
Oh, wow. That makes a lot of sense. You are essentially buying a monopoly on hard-to-reach, affluent residential markets.
Precisely. And you completely change the buyer psychology. You are no longer selling a commodity. You are selling risk mitigation.
You're selling peace of mind.
Exactly. You are protecting their most valuable possessions with a superior steel asset and a delivery system that guarantees nothing gets smashed. Because of that, you command a premium price point, and your customer retention and referral rates just skyrocket. I mean, they currently boast over 1,200 five-star reviews, specifically highlighting this exact peace of mind.
1,200. Wow. Okay, so that covers the product and the positioning. Let's look at the actual business model.
Let's do it.
Because if an investor is actually looking to deploy capital here, they need to know what the day-to-day operations demand. If I buy into this, am I forced to be the guy driving the mule at 6 a.m. every morning?
Not at all. The operational flexibility is actually a major draw for that corporate escapee demographic we were talking about.
Right.
You can absolutely be an owner-operator if you want to be hands-on with the logistics and local sales, but the model is really designed to be highly scalable.
So I can hire a team.
Exactly. Many owners run it semi-absentee, keeping their corporate jobs while transitioning, or even fully absentee by hiring a really strong operations manager and a dedicated driver.
Got it. And physically, what does the footprint look like? Do I need to, sign a lease on some expensive retail storefront with a shiny showroom?
Nope. No retail build-out is required, which keeps your overhead exceptionally lean. Your primary physical requirement is just a secure, properly zoned storage lot.
Okay, let's talk about that lot. Because finding light industrial zoning for a commercial storage yard isn't always easy, depending on the municipality, right?
Oh, it is absolutely one of the primary hurdles in this business. I won't sugarcoat that.
Yeah.
You need a yard large enough to hold your inventory, securely fenced, and zoned correctly for container storage. The franchise corporate team does provide support in site selection, but navigating local zoning laws is just a reality of the business.
But once you have it.
Right. The upside is that once you secure that lot, your administrative operations can run out of a tiny, inexpensive office on site, or honestly, even a home office. You don't need foot traffic at all.
Okay, let's get into the hard numbers. What does it actually cost to get this infrastructure in place?
The initial investment range to launch is between $166,000 and $438,000.
Okay, so $166,000 to $438,000. That's a fairly wide spread. What drives that variance, and what does that money actually buy me?
The variance is primarily driven by your real estate costs, so leasing your storage yard, and the size of your initial fleet of containers.
Makes sense.
But that investment covers your delivery truck, the mule system itself, your initial batch of steel containers, working capital, and of course, the franchise fee.
Okay, let's talk about that franchise fee, because looking at the documentation on the National Franchise Association site, it seems highly unusual compared to standard service franchises.
It is very unique, and it is built specifically for investors focused on multi-unit growth.
Right.
So the initial franchise fee is $139,900.
Wait, almost 140 grand. That sounds really high for a single territory.
But that's the catch. In a traditional model, you pay a fee for one territory, and if you want to expand later, you pay again, assuming the adjacent territory hasn't already been sold, right?
Right.
With STORsquare, that $139,900 grants you the rights to 3 territories right out of the gate.
Oh, wow. 3 territories. Okay, that changes the math completely. So they are essentially forcing you to think like an empire builder from day one.
Exactly. They don't want someone who just wants to buy a single territory and coast. They are basically preventing you from getting landlocked by other franchisees down the road.
That's smart.
You secure a massive regional footprint immediately.
Okay, so let's look at the ongoing unit economics then.
Yeah,
What are the royalties and how does the revenue actually compound?
sure. The ongoing royalty fee is 7.5% of gross revenue.
7.5%. Okay.
Right. And just to touch on qualifications, to even start the conversation, you need a net worth of $750,000 and liquid capital of $150,000.
Okay, pretty standard for a multi-unit play.
Yeah. There are also veteran discounts available on the initial fees, which is great. But to answer your question about how the revenue compounds, we really have to look at the mechanics of the asset itself.
Right, because if I just have 50 empty steel boxes sitting on my securely fenced lot, I'm just burning cash on rent and loan payments, right?
Precisely. Your utilization rate is everything. A container on your lot is a liability. A container in a customer's driveway or at a commercial job site is a revenue-generating asset.
So how do you maximize that?
Well, the best way to think about this business model is to compare it to a high-yield savings account, but with physical assets.
I like that. Walk me through that analogy.
Okay, so when you buy a steel container, that is your principal investment. Unlike a van or a truck, a steel box has almost 0 moving parts.
Right, no engine to fix.
Exactly. The maintenance life cycle is incredibly low. A high-quality steel unit can last 10, 15, even 20 years with basic upkeep. So every time you deploy that container, it generates a monthly rental fee. That fee's your dividend, and it compounds every 30 days.
Oh, I see.
The container goes out, the customer pays monthly, and when the container eventually comes back, you sweep it out and send it right back out to generate another dividend.
That makes perfect sense. The principal never really degrades, but the interest compounds constantly.
Exactly.
But that actually brings up a critical operational challenge.
With that.
If I have 3 whole territories to fill, and my primary market is residential moving, well, residential moving is incredibly seasonal, right?
It is.
Everyone goes in the summer when the kids are out of school. So how do I maintain a high utilization rate in like November or February so those boxes don't just sit empty on my lot?
That is exactly the question a sophisticated investor should be asking. And it leads us perfectly into the growth strategy and really the dual revenue streams of this model.
Okay, tell me more.
If you only focus on B2C, business to consumer residential, you will absolutely suffer from that seasonality. You'll have a booming summer and a quiet winter.
Which is stressful.
Very. The true growth lever in this model is the B2B component, the business-to-business side.
Oh, right. Like if I'm thinking beyond residential, I imagine like a commercial contractor doing a massive hospital renovation or maybe a multi-unit apartment flip.
Exactly.
They would probably pay a premium just to have a secure box on site rather than hauling equipment and debris back and forth every single day.
They do. And the strategic value of that B2B customer is massive. Think about it. A residential customer might need a container for, say, 3 weeks while they transition between homes.
Right.
A commercial contractor might need 4 20-foot containers parked at a job site for 9 months.
Oh, wow. So the B2B side offers significantly longer rental duration.
Longer durations, much lower churn, and most importantly, 0 seasonality. Contractors build year-round.
That's a game changer.
It really is. And think about retail businesses. A boutique might need overflow inventory storage during the holiday rush, right?
Oh, which perfectly counterbalances the winter slowdown in residential moving.
Exactly. Or think about disaster recovery teams, event organizers, or even local municipalities needing secure equipment storage.
It really shifts the perspective entirely. Your fleet essentially becomes mobile real estate.
That's a great way to put it.
You are a landlord, but instead of buying an apartment building stuck on one single corner, you own hundreds of steel rooms that can be deployed to wherever the demand is highest across your 3 territories.
That is the exact mindset required to scale this. And the key to scaling is managing your capital expenditure, or CapEx.
How so?
Well, as you hit capacity, say your fleet is 85% deployed, you have to reinvest capital to buy more steel containers to meet the demand. You are constantly balancing the acquisition of new assets with the revenue generated by your deployed fleet.
It's a fascinating balancing act. So where is this actually viable right now?
Geographically,
Yeah. If someone has the 750,000 net worth, they have the 150,000 liquid, and they are ready to build this, mobile real estate empire, what does the map look like?
it is a true ground floor opportunity right now. STORsquare just launched their franchise offering in 2023.
Oh, so it's fresh.
Very fresh.
Mm.
They currently operate 4 company-owned units, which is actually a great sign
Why is that?
because it proves the corporate team has real skin in the game. They've refined the operational playbook with their own money before selling it to franchisees.
That's a huge green flag.
Definitely. And there is currently 1 franchised unit open in Tennessee.
Which means, unlike the legacy brands where every good market is sold out for 50 miles, the map is basically wide open.
Completely open. Territories are available in almost every single U.S. state right now.
Any exceptions?
The only current exceptions are Hawaii, North Dakota, and South Dakota.
Yeah.
And they are strictly domestic at the moment, so no international or Canadian territories are available. But across the lower 48, an early adopter basically has their pick of prime high-demand markets.
Incredible. So if you're listening, let's connect all these dots here. The journey looks like this. You acquire 3 protected prime territories right out of the gate.
Right.
You establish a secure light industrial storage yard. You capture immediate market share from those frustrated customers of legacy brands by leveraging a demonstrably superior asset. Seamless steel over leaky wood and the no-tilt mule system that actually protects their valuables and accesses those tight driveways.
Exactly.
Then you aggressively target the B2B sector, contractors, retail, event spaces, to secure those long-term high-utilization rentals that totally insulate you from seasonal dips. You aren't just facilitating weekend moves, you are deploying a fleet of mobile real estate that compounds monthly revenue with incredibly low maintenance overhead.
It is literally the definition of a boring business creating beautiful financial statements.
Yeah, I love that. Boring is beautiful.